Good morning, students. So here in last two sessions we have seen what is fund flow statement and also some of the uses and advantages and disadvantages of fund flow statement. Same way also we have seen how to prepare the fund flow statement and what are the steps in preparation of the fund flow statement and what are the four important steps you have studied one by one. So now we will move to the formats of the fund flow, how the four steps are prepared. So first step, we know that it is changes in the working capital statement. So here changes in the working capital statement, how it is prepared and what is the correct format of that statement we will see. And first we know there are four important steps. First one is you have to prepare the statement of changes, schedule of changes in working capital. After preparation that the schedule of changes in working capital, next we have to prepare fixed asset account, and after preparation of fixed asset account, the third step is we have to prepare funds from operation. We have to calculate funds from operation. So after preparation of or calculating the funds from operation, finally we have to prepare this fund flow statement. So here we will see the first format, that is the first step, statement of schedule of changes in working capital. So here the statement is prepared with 5 important columns. So first column you have to write particular. Second, you have to take previous year informations or previous year's datas and current year datas. And fourth one is increase, last one is decrease. So here, if this increase and decrease means here in every particular asset or liability, by comparing previous and current year data, we have to calculate whether there is any increase or decrease in that asset or not. That means if there is any changes in the asset value or liability value, you have to see. So first we take current assets. So we have already seen the list of current assets. So in that first, current investment, temporary investment and short term investment. These are the three types of investments which are used under the current. There are two important investment. One is temporary and second one is short term investment. So here we have to from the given problem, first of all you have to say you have to take current investments. Under that, temporary investment and short term investment you have to write, and we have to take first previous data from the previous balance sheet and current year data from current year balance sheet, and then we have to compare whether there is increase in the value of investment or not. If there is increase, then you have to write in increase, record in increase column, and if there is any decrease in the value of investment, it is recorded in the decrease column. So like this, for every asset and for every liability we have to record. So next one is inventory, stock. So we have to see whether the stock of last year and this year, this current year stock, you have to compare. If there is increase, you have to write in increase column, and if it is decrease, you have to record in decrease column. Next, trade receivables, that is the debtors and bills receivable. These all information, the data will be given in the balance sheet. In the problem, just you have to pick it up and you have to write in a very neatly, regularly, and you have to arrange it properly. So first you have to take current assets. Under that you have to write current investments, and under current investment, temporary investment and short term investment. If it is given in the balance sheet or in the problem, then only you have to write. Otherwise there is no question of writing all these things. So first what correct information or particular information is given, that information is to be written in a particular format, neatly, and arrange it properly. And next one is trade receivables. So here there are two important trade receivables. One is debtors and the second one is bills receivable. and we have to see whether there is increase or decrease in the value of debtors or bills receivable, and if it is increase or decrease we have to write in a its correct column, because if you write in a wrong column or record in a wrong column, the problem would be wrong, or otherwise we will get a different answer, or it may get we may get a wrong answer. So same way cash equivalents, whether it is a cash balance or a bank balance, and from this we have to again we have to take a previous, we have to compare it from previous and current year, and we have to find out, or we have to calculate whether there is increase in the cash or decrease in cash. So same way when we take liabilities, so short term loans and advances we have to write, and we have to write the information, that is previous information, year information and current year information, and then we have to compare it, and we have to see whether it is increased or decreased. Prepaid expenses, short term loans and advances, that is prepaid expenses. Other current assets, outstanding incomes. Now after taking the current assets and the current liabilities, here all current assets uh, are named as capital A or anything for our convenience. For it must be very easily we can we have to nominate the current assets as A or Roman 1, anything, because at the calculation of decrease or increase in the working capital, we have to deduct current assets from current liabilities from current assets to find out working capital. So therefore we have to separate name separately current assets as A, current liabilities are B. So here now the current liabilities are short term borrowings, that it is like a bank overdraft, short term advances, and trade payables. Creditors and bills payable are the two trade payables, and the current liabilities, the outstanding expenses, short term provisions, that is deferred payable, proposed dividend, provision for taxation. So after recording all these things, we have to compare it previous year and current year data, and we have to just calculate whether there is increase or decrease. If there is increase, we have to write in increase column. If there is any decrease in the value of asset or a liability, we have to record in decrease column. Like this, finally we have to balance it, and we have to see whether there is any changes in the working capital, or whether there is an increase or decrease in the value of if there is any decrease or increase in the working capital. So here in one column, it may be in increase column or decrease column, we will get amount. It may more than decrease, or it may be in the decrease column more than increase column, and if there is any balance between these two, that balance is known as a decrease or increase. So like this we have to calculate the increase or decrease in the working capital. So here like this statement of schedule of changes in working capital, this statement is very easy, and here only the thing we have to do is just we have to sort out the current assets and current liabilities and write in a particular format, or arrange it in a particular manner, and after that just we have to compare with the previous year data and current year data, and just we have to calculate only whether there is an increase or a decrease in the value of the particular asset or a particular liability. Finally when we balance it, we will get some balance carried on. Such balance carried on is called as a decrease or increase in the value of working capital. So next is preparation of fixed asset account. We already seen in last session that why this fixed asset account is prepared. So here this account is prepared to only to know any purchase or sale of fixed assets made during the period, whether the any assets or assets are purchased or sold out. So to know only the purchase or sale of fixed asset, to know this information we have to prepare this fixed asset account. By comparing the opening and closing balance, pass an entry for the depreciation. The difference now represents sale of purchase of fixed asset. So here if there is any difference between the purchase price and selling price, that the difference is called as any profit or loss on account. If the closing balance is more than opening balance, it indicates purchase of an asset. Here if the opening balance closing balance is more, here example, if the assets are purchased at 10,000 and so closing balance is 15,000, means there is a difference of rupees 5,000. So such amount, here opening balance is less and the closing balance is more, means here during the period of during that period we have purchased additional capital or additional asset of rupees 5,000. So here if the asset balance, that is the closing balance, is more than the opening balance, it means it indicates that there is an purchase has been taken and purchase has been made. So therefore here, to know whether the assets are purchased or sold in a particular during the period of time, to know to get this information, we have to prepare the fixed asset account. So third step is preparation of adjusted profit and loss account or funds from operation or trading profit. So here funds from operation we have to calculate. So first of all, see what do you mean by funds from operation. So the term operation means day-to-day affair of the business. So here operation means it is a day-to-day activity of the firm or the business or the day-to-day affair of the business. It refers to those activities which are trading. These are the activities which are trading, means these are the activities which are taken for the purpose of the business. So such activities are called as the operation, called as operation. While calculating funds from operation, non-trading items should not be created operationally. So here non-trading items are not taken. So non-operational expenses includes non-operational expenses or non-operating expenses include depreciation, next loss on sale of fixed asset, writing of fictitious assets such as goodwill, preliminary expenses, discount or loss on issue of shares and debentures. So these are the non-operational expenses. So these expenses are not included at the time of the calculation of funds from operation. So non-operating incomes such as profit on sale of fixed asset. If there is any profit on sale of fixed asset and refund of income tax, dividend received, then rent received, compensation received. So these are the non-operating incomes. So here these are the two lists of non-operating expenses and incomes, and in non-operational expenses we include depreciation. These are the non-operational expenses, and non-operating incomes we have seen profit on the sale of fixed asset, refund of income tax, dividend if any dividend is received, or rent received, or compensation received from the firm. So next, methods of calculating the funds from operations. Here there are some of the methods for calculation of funds from operation. So here there are three methods to calculate the funds from operation. They are as under: first one, statement form. So the calculation of funds from operation can be calculated in three methods. So first one, statement form, next by preparing adjusted profit and loss account, and finally the direct method. So these are the three ways to find out the funds from operation. So first of all, we will take a statement form. What do you mean by statement form? It is to be prepared in order to calculate the funds available from operation. While preparing the statement, certain items which are non-cash by nature are debited, such as depreciation, discount on debentures, preliminary expenses, etc. They are to be added back the closing balance of profit and loss account. So here in the form of statement, here first of all we have to take the non-operating expenses. So these are added back to the closing balance of profit and loss account. So next, similarly, there are certain items of incomes such as dividend received, that non-operating incomes, and appreciation in the value of fixed asset, profit and sale of fixed assets, which is to be deducted. So here first of all we have to start with the net profit as per P&L account. Then we have to add the non-operating expenses like discount on debentures, depreciation, preliminary expenses, and other things. And same way here the non-operating incomes are to be deducted from the balance after adding the non-operating expenses to the net profit, closing balance of P&L account, and from that we have to deduct the appreciation in the value of asset, profit and sale of fixed asset, etc. to be deducted. Then the adjustment will also have to be done in respect of excess of deficit provision. So here how this statement form is prepared, we will see here. So statement of funds from operation. So here how this statement of funds from operation is prepared. So first one we are taking here, we are preparing this statement by 3 columns. One is particular, second one is inner column, and final is amount column. So here under the particular column, first we start with profit as per P&L account, that is closing balance. It is clearly shown here that is the profit as per profit and loss account closing balance. And after that, to the closing balance of profit and loss account, we have to add non-cash or non-operating expenses. So we know already the list of the non-operating expenses. So we take goodwill, patents, trademarks and preliminary expenses, depreciation, discount on share of debentures, transfer to any reserve, loss on sale of non-current fixed asset, dividend, that is proposed dividend, provision for taxation. And these are all the non-operating expenses which are to be added to the closing balance of P&L account. And then we have to find out the balance and we have to make total. After getting total, from that we have to deduct the non-cash or non-operating incomes. So here non-operating incomes, the list of non-operating income is profit on sale of fixed asset and non-current assets, which if already credited to P&L account. Then profit on revaluation of asset, if there is any revalue or the changes in the value of realization value of the asset. Next, excess provisions, if there are any excess provisions, profit and loss as per the P&L account, that is the opening balance. So here from the total of closing balance of P&L account and adding to this profit the non-operating expenses, after getting the total of the profit and loss account, closing balance and non-operating expenses, from that we have to deduct the non-operating incomes and the profit and loss account, the closing balance. After deducting these things, we get finally the net funds from operations. So here like this statement of funds from operation is prepared, and this statement is used in day to day in our accounting books. So here for the examination purpose, this statement of funds from operation is very important. So this format is used everywhere for the preparation, for the calculation of funds from operation. And here only the thing is, so first of all we have to know how to prepare the first step, that is changes in schedule of working capital. Second one is the preparation of fixed asset account. If there is any profit or sale purchase or sale of asset taken place in the period, that time that asset account is prepared. Third one is statement of funds from operation. This statement of funds from operation is prepared by considering the net profit closing balance as per the P&L account, and for that we have to add all the non-operating expenses. Then we have to total it. From that total we have to deduct the non-operating incomes. and the closing balance of the opening balance of P&L account, which will be given in the problem, and by deducting from the total we get finally then we get net funds from operations. So like this, these three steps are studied in this session, and these three steps are very important for the purpose of preparation of fund flow statement. So I hope you all understood. Thank you.